Hi, everyone, and welcome back to part 4 of our Professional Investor Business Plan live series. In the last few chapters, we have covered a lot of groundwork, including the executive summary, our income objectives and vehicles. We've created a routine, a robust routine, and put into place set working hours every week. We talked about and we covered money management, which I believe to be the kingdom of wealth. And with that, we also talked about milestone planning as well as retirement planning, milestone planning for trading, KPIs for trading, and retirement planning, financial planning for investing. Basically, what we've done is we talked about the pursuing and the setting of goals. What we have not yet covered is the ways in which we try to achieve those goals. And what are the actions, what are the rules that we're going to live by and abide by day in and day out as a trader? This we need to cover as well within the My Trading Rules and the My Investing Rules topics. And they are part of the setting, the pursuing and setting of goals. And we're trying to achieve those goals in following the set of rules that you guys are fully aware of, I'm sure, but that we will everything now put together in one document. And so we'll create a checklist that you guys can follow step by step by step, starting with what makes markets move, location, direction, our indicators, which include the COT index, true seasonality, valuation, a combination of those setup tools, of course, the market timing, the lower time frame zoning, and the trade management. As you can see, these are just all the rules that will come into place for trading. And then there will be separate rules for investing as well. And after that, our jobs are not even done, right? The last and final chapter following our rules is going to be the trade log. And the trade log is going to be around the assessing of our goals. So you can see the entire document is built around, you can, well, summarize that in one sentence, the pursuing, the setting, and the assessing of our trading as well as investing goals. That's what this document is meant to do. It's supposed to cover all aspects of your trading and investing careers from now on out. And of course, we're going to give you access to this document as well once we're done. But why I'm basically not yet giving you full access is because I'm aware that potentially along the way, we may change, or not change, but add on those rules, potentially some screenshots or some best practices to make it more understandable, to also help you visualize some of those rules, especially if you are in the beginning shoes, right? And so without much more introduction on what we have done so far and what's going to follow next, even after today's session and next week's session, let's just all jump straight into My Trading Rules. And before we even begin to talk about the rules, we need to talk about the markets first, because we just trade so many of them, right? We are trading futures, we're trading Forex, we're trading stocks. We can also trade cryptocurrencies. And even within the markets, within the assets, as in futures, for example, you have different key characteristics in terms of the different markets that we can trade. The commodities, within the commodities, whether we trade grains or whether we trade precious metals or whether we trade energies, the markets may differ. And the key characteristics, the advantages and disadvantages may differ. And with that, of course, the fundamental drivers on what really moves those markets, they differ as well. Now, what we have done is we've really simplified the strategy in a way where it's applicable to all markets. Whatever we use, whatever we do, whatever we have shown you, these are very versatile tools that you can use across assets. But of course, you have realized yourself probably that some of those tools work better on some than on other assets. And within assets, even they may work better on some products than on others. And so while I can give you a rough guideline, let's call it, or a rough checklist on what to do for our markets, at the end of the day, as you can see, there's a lot of pages that we will cover here. At the end of the day, this document still requires work from your side, especially if you're a beginner and you want to add screenshots, you want to add some special potential rules for some that are unique to some products, right? And so I cannot even begin to list them all here because we would be never done. And I'm sure I'd miss some along the way as well. This all boils down to one of the beginning slides where we said, this is going to be a living document. So whenever you see us in a DMO talking about something or covering something that is asset or market specific that wasn't on your radar yet, you need to add that tool or that strategy within your My Trading Rules section or the My Investing Rules section, if you will. So what makes markets move? Well, we've got finite markets and we've got infinite markets. In reality, we probably have a little bit of a mix here as well for some markets, but we can really simplify all the assets that we trade into these two categories, finite markets and infinite markets. And there's a fundamental difference between these markets that we trade. So finite markets are commodities like sugar or wheat, and infinite markets are markets like stocks or equity indices. And because those markets are fundamentally different in the way they're set up, they're also going to be different fundamental key drivers that will move those markets that we need to understand, learn, study, and apply. And so let's start with finite markets. What are finite markets? What do I mean by that if I say finite markets? Well, if we look at the finite markets, mainly the commodities, we know that the lifespan of a commodity is quite short. It goes from producers to users, and then it's all over. Sugar and cacao are made into chocolate, wheat is made into flour, gold and silver are used for computer chips or nice jewelry. The interesting key part here is that the key players for commodities, for finite markets, are exactly these people, the users and producers, the so-called commercials. These are, in short, institutional powerhouses of the marketplace. And in fact, they're so powerful. You have to imagine that they're so powerful and they're so big that they are required by law to report their buying and selling activities once every week. We as retail traders don't have to do that. Though, of course, we can also see our group as a trader displayed within the so-called Commitment of Traders report. However, that is not because we have to report it. It's because they're taking the reportables minus the total numbers of contracts, and they end up with non-reportables, which then end up to be the public, us basically, but we go into that later as well. And so these institutional powerhouses, they're so big that they are required to report their position size and what they're doing, whether they're buying or selling, once every week. And so for commodities, for our finite markets, we will not just look at the price charts, the technical analysis, but we'll also look at the key players that will move those charts, which will be the fundamental analysis. What makes our infinite markets move? What makes markets like stocks or equity indices move? It's not as easy as just saying the producers and users, because what is the lifespan of a stock? It's infinite, right? And so what I found the most consistent key driver for infinite markets to be is the anticipation of increased earnings. So forward PE ratios and interest rates, bonds, and the relationship between the price of a stock and the interest rates and the bond and the spread that results out of that. And so if the forward PE ratios, for example, are low, that specific stock may be undervalued, right? And if a forward PE is high, that specific stock may be overvalued. And at the center of all of that are then going to be stories and news and whatever else you're going to find in the media, in the free media. So what we can conclude by that is that stocks, they don't rally or drop because of real physical supply and demand. A company can always print more shares, and we in fact can live our entire lives without owning one, but we can't live without coffee beans. Well, at least I can't, you maybe, but I can't. We can't live without gold. We can't live without silver. We can't live without crude oil. And so the fundamental key drivers of what makes those markets move with the limited supply and that there will always be demand are very different to what makes the infinite markets move. In reality, you also have another group, which I call the man-made commodities. They're a combination between infinite and finite markets. That would then be kind of like the Forex markets, right? And we will cover that later as well. But I want to keep it really simple here on what makes markets move. So it all boils down to the right analysis at the end of the day, which then sets us up for our trading rules. And so should we follow the fundamental or the technical analysis? And what is the difference anyways? Technical analysis is most of what you have learned in the blueprint and price action course material within the classroom section. Supply and demand and or price action, they're technical analysis tools because they're purely based on price and chart patterns or formations. They can also be based on volume or moving averages. All of that, we would call that technical analysis. All of that does not even begin to look at fundamentals, right? It's just looking at price and price itself. Now, what I have found to be true, even though some of those price technical analysis tools work wonders, even isolated at times, that for most times, as we become advanced traders, those technical analysis tools should only be used to time the markets. Now, what do I mean by that? Timing the markets means, where do I put my entry? Where do I put my stop loss? And where do I put my target? How can I time that market effectively, efficiently with a good risk to reward proposition? All of that you have learned and mastered in the blueprint course and or in the price action course material. And you've really probably already mastered the art of timing the market. And I really believe that supply and demand is the most powerful technical analysis tool out there. We can do that consistently, even isolated. And some of our students have proven that they can be consistently profitable in the marketplace using just supply and demand. And that's how powerful that tool is. But it's not the be all and all of the market. In my opinion, even though supply and demand sometimes even does a good job in predicting, if we do it correctly on the higher time frame, major rallies and declines, I believe there are even better tools out there to forecast. And I believe that those, let's call them predictive tools, those forecasting tools, they're not found in the technical analysis. I believe they're found when looking at the fundamental condition of the market. And so fundamentals, more than technicals, will help us in determining whether we can expect a substantial move or not. And oh boy, we can learn so much about the trades that go really, really well. We can learn so much about them if we study them, if we assess them within our logs. And you'll find that most of them have something in common. The ones where we find we get the biggest moves out of and the strongest moves with the least retracements, where the opposing levels are just taken out, like supply and demand doesn't even exist, are the trades where the fundamentals align perfectly, right? And we will cover that later as well. Example, palladium, historical levels of commercial accumulation. We're now at an all-time high. We predicted the low of a downtrending market and predicted this was going into an all-time high, which it now almost does, and it's going through monthly and weekly supply like it's nothing. And so we have to cover that. We have to talk about the best practices and assess our trades as well. So where can you learn fundamentals? Technicals, you should have learned within the blueprint and the price action course material. The fundamentals are taught in the all asset mastery classes because each asset is different, so they have different key drivers. So the commitment of traders report is part of the futures course, and seasonality is part of all the course materials, Forex futures and stocks. And on top of that, we've launched an indicators course that emphasizes on these fundamental strategies with proprietary indicators and tools that you can leverage on. However, it is important for you guys not just to follow those indicators blindly, but rather understand what the mechanics that's underlying those indicators, right? What makes the COT, the Campus COT index, go give us a sell signal? How does that work on the lower time frame cycles and on the higher time frame cycles? How does that relate to the COT net position? And really, we need to understand that. So we can summarize that the technical analysis, the technical chart analysis is objective, and it's extremely powerful for market timing. It's supply and demand is the most powerful tool we can use for market timing. Fundamentals, they lack market timing, right? Sometimes we get a setup and it takes ages for the market to respond to that setup. And so fundamentals lack market timing, but they're a lot more predictive of where major market moves may take place in the future, because fundamentals drive price. Price doesn't drive price. Fundamentals drive price. And so ideally, in an ideal world, we want to combine the best of both worlds. So a good trade to us will consist always of two elements: the underlying fundamental condition of the market, the so-called fundamental setup. And when a market sets up fundamentally, it will, of course, not tell us at which price to buy or when to buy or sell. It's just telling us, hey, we better focus at this market right now. And we look for entries in this market. And so after that market sets up fundamentally, we then want to time that market, of course, as well, right? Because we don't just want to jump in and press the market button and at the end of the day, maybe achieve a one-to-one. Well, we know we can't be consistently profitable just achieving one-to-ones. We need to be better than one-to-ones. So we need to have a focus on a quality risk to reward proposition. And we use our technical analysis tools to do that and to enter a market before it completely takes off. And so you can see on the left side, there are going to be also technical setups as well as fundamental setups that we have to analyze. And the technical setup on the higher time frame is location, direction, and the fundamental setup is then going to be around our indicators. So what we're now going to do is we're going to go down step by step the list of the checklist of what I believe our rules should be within also the same order, how we should apply that. And as you can see, there are a lot of pages here. There may be a lot of things that you want to look at all the way until step 5, trade management. There's a lot of things we want to take into consideration. And in the beginning, you may take a very long time to analyze just one market. All of that, however, as it becomes second nature, right? For a lot of you, this is already second nature. Even though this is a lot of pages, you actually can do that rather quickly. So it only takes a couple of minutes to really analyze a market once you become efficient at that. In the beginning, though, just understand that it will take a long time. Now, I will do my best to cover again the advanced as well as the beginners in the room. I will try to do this detailed. If I lack the detail or if I go too fast, you guys have to voice that, communicate that to me and tell me to slow down. And or if you don't understand anything of what I'm saying on specific topics, please feel free to ask questions and tell me to go into examples. I will do my best to find examples on the spot. Oftentimes, some of those rules will be situational, where sometimes we will look at it, sometimes we don't look at it. And so I'll do my best to find it on the spot. And what you want to do, of course, then from your side is as well is put screenshots behind those too. Excuse me. So step number 1, location on the higher time frame. Cervantes is saying, I'm just reading this out loud. The written plan and editing as you go is a game changer for me, at least in brackets. Yes, it truly is, because and I tell you why, it helps you organize your brain, when to do what without missing what may be an important piece of the puzzle. And so as you're as you're beginning this journey, potentially, we talked in the beginning in a prior lesson about that stair-stepping approach on learning. If you go too fast on the stair-stepping approach, as you enter the second or the third step of the staircase, your brain is so focused on that step that you may, within doing the analysis, forget everything that you've learned before, or not forget, but forget to apply it. So a checklist will always help you to organize your brain and follow all the rules without just having too much of a focus on one and losing the focus on others, which may be similarly as important as the following rules that obviously you're learning. So with step 1, what we're doing is we're analyzing the location on the higher time frame, and that is what I call a technical setup. Look, the location analysis helps us to assess on a technical base, on a price base, where a stock, let's call it a stock or an asset, may be cheap or expensive. If you were to talk about fundamentals, you would be speaking about undervalued and overvalued. Here we just speak about in terms of price, we speak about what is a cheap price. what is a wholesale price and what is a retail price. And we want to identify that in following the following rules. Step number 1, identify first fresh level of demand below current price and first fresh level of supply above current price. Now we measure, when we do this analysis, we measure freshness as well as the quality of our leg out. We do measure freshness based on the preferred version. We use a 25% rule here. And the leg out only has to be decisive. It does not have to be explosive. It's different to the lower time frame rules, where in the beginning you may say you want to have explosive leg outs. So the leg out only needs to be decisive. There's also an alternative rule, which you will use if a higher time frame level cannot be identified close by. And you will then say everything that looks like a level is a level. And here what you will do is just visualize levels based on the formations themselves: drop-based rally, rally-based rally, or rally-based drop, drop-based drop. And just on the pure formation of the chart, regardless of the candles that are within that, indecisive, decisive, explosive, and so on, we will take and put those levels in. Step number 2 within that analysis is we identify favorable price location in terms of potential buying opportunities that will be low and very low, and selling opportunities high and very high. It is also okay to buy and sell in equilibrium if we go with strong existing trends. However, in this case, we know that profit margin will be less and the probability of success will be less. Sometimes we just don't have another choice than to also look at equilibrium. So that is situational. What we want to achieve with that, we want to buy low and very low, we want to sell high and very high, is that later on, as we go into the lower time frames, the lower time frames should always be within the right context of our higher time frames. They should be located within the right context. So we will never look at a lower time frame supply zone that's part of a low location area and vice versa. We will look at a lower time frame supply that's part of high and very high. And we will look at lower time frame demand that's part of low and very low in terms of the higher time frame technical setup. Some advanced steps that we can do during this analysis. We will check not just for 2 levels, we will check for multiple levels. And with that, we will also check for the zone quality. Is it a quality monthly demand that we're looking at? Or is it not so quality? And therefore we may want to go lower. That is where experience will meet the rules eventually, right? When do we want to check multiple levels? When do we want to go with the first one? In the beginning, the rule will be the first level, right? And so you will try to put more levels in eventually though. We will look at flip zones, we will look at originality, and we will look at monthly coverage, even if monthly income is not our income objective that we're working on at the moment. Now, all of those are very situational. We will have them on the radar, but we will not always find those and put those steps into play. What you will always put into play is step 1 and step 2. After location, we move on to the next chart, which is direction, also on the higher time frame. That's also to get a better understanding of the technical setup or the higher time frame context in which price is moving in at the moment. And so are we in an uptrend? Are we in a downtrend, sideways trending market? That is what we try to achieve with direction. And so direction is probably one of the most abstract and most complex technical ways of analysis, even though, in my opinion, it's also one of the most abused words in the world of trading. And everywhere we look, we hear people talk about trends and uptrends and downtrends, but they never do that with context. So when we do the trend analysis on the higher time frame, we always have to look at the right context, and we may want to look at different contexts as well. So let's just go through step by step. Step 1, from right to left, identify at least 6 pivot points with approximately equal percentage changes, at least 3 lows and at least 3 highs. And pivot points, what are pivot points? Pivot points are areas where price truly changed its trajectory course, right? So it went from going down into going up, and from going up into going down. And we try to be consistent with the changes here, the percentage changes. The definition of an uptrend is to have at least 2 consecutive higher lows. The definition of a downtrend is to have at least 2 consecutive lower highs. Where in an uptrend, our lows are more important than the highs. And in a downtrend, the highs are more important than the lows. That has to make so much sense, right? It sounds so simple, but it's actually, to a lot of you, it may not be that simple. Well, if you have lows that are holding, and even if they are within the same area, I will call them higher lows, because to me, it means that the buyers are in control. Whatever we are looking at is currently in strong hands. That is because the lows are holding. Vice versa, if the highs are holding, the hands that are holding this are very weak, right? And so even if the highs are, even if we don't get proper lower highs, but within the same range, the same kind of highs, I will call them lower highs, and I will determine this to be a downtrend if I get 2, because I can see that the sellers are starting to be in control and that specific product is in weak hands. That will be important later on as we look at comparative strength as well. And we can look at comparative strength really when looking at all sorts of assets, even cryptocurrencies. And so if you, for example, look at cryptocurrencies right now, you can compare the lows that have been created on Bitcoin and Ethereum versus the same time frame lows that have been created on, let's say, altcoins. And if your altcoins have made lower lows as opposed to Bitcoin and Ethereum that drive the market, then you know that those altcoins are comparatively weaker. They're not in strong hands. Though if you find altcoins that where the lows are holding, similar to Bitcoin and Ethereum, what you can do with that, you can predict those to be the winners of tomorrow, because you can see, technically speaking, just looking at price, that those are in fact in the strongest institutional hands. So looking at the lows versus looking at the highs is very important for us, not just for trend, but also for other analysis techniques. We really want to master that. On top of that, what we do is we want to identify longer term trends, momentum, as well as correction. What is the weaker move of the both, and what is the stronger move of the both? How you can identify that is simply looking at in which direction do I get most of the levels completely taken out, like a hot knife goes through butter. That will be a sign of a momentum move. Very fast-paced, a very strong. Correction moves take a lot of time. And even though one side may be holding off better than the other side is also sometimes holding off quite well. And so the correction moves, they take longer. And so what's important with that is that as we look at different contexts of charts of price, is that a daily downtrend can be part of weekly correction within a weekly uptrend. Very important here. A daily uptrend can be part of weekly correction within a weekly downtrend. Now, what does this look like? Let's see if I can draw something. Yes. So let's just say we have an uptrend, Oh, here it doesn't work. Let's just say we have an uptrend, right? And that uptrend is based on the weekly charts. Now, what you can have within the daily chart is you can have downtrends forming within what would be only the weekly correction move. So in fact, the momentum would still be up. The weekly momentum would be up, even though the daily downtrend would be down. And so for us, it's important to identify that, because as we may be shorting with the downtrend here, right? We need to be aware that potentially there's going to be another impulse move higher within that overall uptrend. And so eventually you then will get a bell curve, right? And that bell curve will then move lower, where then you will go into a sideways trend and then eventually into a downtrend. And in that downtrend, we have to be aware that those corrections moves that within the weekly downtrend could be daily uptrends. And so we may have daily uptrends here within those correction moves. And so in this case, what we do want to do though, is rather trade with the overall impulse. So you can see even then, and that relates to all time frames as you compare those time frames, always the higher versus the lower time frame. We could have a monthly uptrend, and within the monthly uptrend, the monthly, what is the monthly correction is going to be a weekly and a daily downtrend, but the impulse on the monthly is still up. And vice versa, if we have a monthly downtrend, we could have a weekly uptrend, but that weekly uptrend would only be the correction of that overall downtrending market. So extremely complex analysis. We have to look at this from a lot of different angles, and we cannot just say, very rarely I will just say this is just an uptrend, right? Because apart from, well, unless we're looking at stocks, very rarely this will be the case. In stocks, of course, we have the benefit of the natural updrift of price, where most stocks will be in strong, well, a lot of stocks are in strong uptrends. And so let me remove all of that again. And so, for example, if that is not clear for you, right, what you want to do eventually is then you want to look at the analysis that we do, right? And then, for example, go to precious metals and go to gold, for example, where if you see this analysis here, right, then up until this stage, if we just look at all of this here, then we would understand that at this point we are in a downtrending market, yet we are buying this here. Why are we buying this here? We're buying this because we can see this is the impulse, and we can, because it's very fast-paced, strong, and we can see this is just a correction move where it's taking a lot of time, it's up and down, and the demand sometimes just working as well as the supply at times. So the moves within that, they're almost like the equal length, right? If I look at these lengths of those moves, they're almost the equal length. While if I look at the length of those moves, those moves, those moves, those moves, and those moves, and I compare it to this, 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 and this, I know which one is stronger. So clear impulse up, correction down. And so what we're predicting is that downtrend on the weekly is part of a potential monthly impulse up move, where it's just taking a breather, and now we can expect another impulse up higher. And so it's not enough to just say this is a downtrend. We need to look at where's price coming from, and therefore where's price going to go next. Again, it's a study of the past, right? Trading is a study of the past. It's always been that. Moving on. What we also do is we identify chart patterns, cup and handle, trend lines, bull or bear flags, head and shoulders. All of that would be part of price action. And so you can see price action is not they are not standalone tools that we base decisions on. We use price action to get an additional understanding of what price may be doing. And so same example on gold, what we knew within that downtrend here, right? We had a triangle, a cannon bomb, which broke up to the upside, and we had this bell curve, and then we have also a cup and handle forming. And if that cup and handle is playing out, we get another impulse into new highs. And so that is a technical price action way of looking at charts that will also help us to get further information of where price is going to go. It's going to give us further information in terms of where price is going to go by looking at the past. We need to study the past to make sense of the future. That's just how it is, right? We always will go back to the executive summary. They make future predictions based on a study of the past, right? And so that is what we're doing. So that is just an example here. Again, you really want to do the job and add those kinds of screenshots here. Find those kinds of screenshots in your charts and add them as a visual image for your trade plans. I will not add it because each of your eyes may see some things differently, and you want to add those images that make the most sense to you. What I find very powerful here is the trend validation tool that we can use. That's basically the zigzag percentage indicator from TradeStation. And as we add that into the trend chart, we want to manually change the retracement point inputs respectively in terms of the chart, the asset, the product that we're looking at. So if we're looking at something that's extremely volatile, you want higher retracement points. If you're looking at something that's extremely low in volatility like Forex, you want to look at something that's lower in the retracement points. And so even with the trend validation, we need to do a little bit of manual labor to check that what we did is right. But I like the trend validation because in the beginning, as this becomes very complex, that helps you to get a mathematical calculation behind that. That helps you to put the pivot points into play, but oftentimes my own pivot points will overrule the zigzag tool. So sometimes I will take one out or put another one in, depending on what my eyes see. So I only use this as a trend validation because I believe our eyes, right, are stronger than a automized tool that TradeStation is giving us. And so as traders, we always have to use our eyes. We always have to use our brains. It's a thinking game, right? Speculation is a thinking game. It's not a game to automize. It's never been that way, right? Unfortunately, it's not that easy. Even though we can automize some of the steps to help us to make it a little more user-friendly and easier and less time-consuming, we always have to use, at the end of the day, our own eyes and need to understand the mechanics behind it. And that's why it's only validation. Only validation. We need to train our eyes to see this, to see these kinds of patterns, right? Because if you don't on gold and you just say this is a downtrend because you're following the zigzag, you may be on the wrong side of the trade, right? And or you may miss this opportunity on the way up. Both would be pretty bad outcomes. Sorry. Some advanced rules on trend. We want to identify potential anticipatory trend change scenarios. We do that with also looking at momentum and correction, but we also have a few rules separate to that and individual rules. One of them is the monthly high quality opposing supply and demand zone rules, right? So if I find that high quality zones are opposing, I can potentially predict the end of the band within that area, right? And so also we have the 4 out of 5 pivot rule, where we anticipate the second higher low or the second lower high in the process. All of that should be, when we do that, all of that should always be covered with the long-term fundamental setup tools that we will now talk about. So I will only predict the trend change if I have some of our fundamental setup tools. Also, if I have those aligned with our technicals as well. And so an example for that was for example, our palladium trade, right? That we took against the trend. We predicted the end of the band and for palladium to make an all new high. 1,500 to 3,000, it's a doubling of a precious metal. We predicted that. How did we predict that? Not because we looked at price, right? Though as we looked at price, of course, price was in monthly demand as well, right? Price was coming from monthly demand, but you may have said, well, this monthly demand is tested, right? And it's tested by a lot. And so this is monthly demand, but more important than that, we had our fundamental setup tools that were aligned at that stage, which was historical COT accumulation, commercial accumulation at that point. Historical levels, never have we ever seen that in 20 years. Plus seasonality to be up at that time. And so we could predict the end of the band within monthly demand, even though if you look at that weekly chart, we were in a downtrend, right? And so you may be saying, well, we're in a downtrending market. How the hell are we buying? Why are we buying this? We should be selling. No, we should be buying. And that is why price does not move price, right? Price is not a forecaster of, it can be, but it's not as powerful of a forecaster as our fundamental tools, because our fundamental tools, they drive price. So we don't just look at price, we look at actually what is the key driver of what makes price move, right? What changes price? What changes that trend? What's the underlying condition that is changing that trend? And so the combination of seasonality as well as that all-time high accumulation in terms of the commercials is the fundamental key driver that has changed palladium from going into from being a downtrend and now all of a sudden without very little retracements, just going up like crazy. And with that, just going through all the supplies like a hot knife goes through butter. And so supply is only supply until it's not. Demand is only demand until it's not. Those are very powerful timing tools if we use them with the right context of fundamentals and the higher time frame technical setups, right? And so they're powerful market timing tools, but not if we use them against all other odds in terms of fundamentals. Then it probably means that we will be on the wrong side. If we had shorted this because monthly supply and weekly level on top of level, very textbook, doesn't get much better than this, you would have just been taken out. Maybe you would have been able to put your stop loss to break even here, but eventually you would have been taken out. And so fundamentals are, you know, what I'm going to show you are well-seasoned forecasting tools that we need to incorporate into our analysis, as opposed to the technical tools of timing the market. And so our long-term fundamental setup tools, this analysis, at least the long-term analysis, has to come into play. What is this stuck here? No. Okay. Has to come into play when we do the direction analysis. And so you will see, as I have the way I have my chart set up is on the trend chart, I exactly have that indicator, the long-term COT index and the COT net commercials. I have those two indicators because it's not enough to look at trend. I need to know if we are potentially at the end of the band. And I need to know that fundamentally if we have some risks on that. And don't worry if now, you know, I'm seeding some of the information that we will cover later in terms of the commercials. Of course, I'm going to reap on that information and really spend time on this, explaining this in detail, right? So, of course, I'm just obviously to also give you the full context. I sometimes have to talk about some things that I can only then cover in full detail later on. That's just how it's going to be. So potentially what you want to do is you want to watch all of this again, right? Once also you have the document, watch it again and take your time to put in screenshots and all of that for you. Siwar is asking, what's the difference between net commercials and the COT index? And exactly that is this here. It is important, very, very great question, Siwar. And I think it's not clear to, you're not the only person that may not be clear to. It is important for us to understand the underlying mechanics of our indicators, the proprietary tools that we've created. And so if you look at the index here, that's the tool that we've created. What's underlying that tool is the net positioning. So first we have to understand and study the net positions to really understand this tool here well, because oftentimes, even though most of the time this is correct and it's like, again, an easier way to use this, it's best to be used once you understood the net positions. With that index, I just found that it's easier to really understand where this calculation comes, how this calculation really comes into play, right? And so, for example, now we would be showing completely a flip-flop on the long term. Well, best to cover this maybe later. But yeah, on that point, Siwar, what you want to do is you want to go through the futures commitment of traders report lesson. And not just Siwar, everyone wants to do that, right? Everyone wants to do that. And when we launched the COT indicators, a lot of you have heard the word COT for the very first time. And so here is the commitment of traders report as lesson 1 of the module 5 expert within futures. It's lesson 1. It's even taught before seasonality. So you want to watch that right here, right? And here you can see the way how we then analyze the COT net position. And so you first also want to study that before you study the indicator itself, because I believe I also said that in the indicator course, that indicator is based on that lesson here. And it's just basically emphasizing and giving more ways on how to look at this, easier ways, but we need to really understand both. Does that make sense, Siwar? I'm going to explain. Obviously, now next step is our indicators as well. And we have roughly 10 minutes left. So maybe we can talk about the commercials for 10 minutes. And then we'll call it a day for today. So after step 2, and within step 2 is our long-term fundamental setup tools. And the first thing that we do here is we look at our Campus COT index. which is one of our fundamental setup tools, right? So we have the campus indicators, we have the COT index, the true seasonality, and the campus valuation. Later on, we'll combine them for the best fundamental setups, but we need to understand all of them. The first that we should look at is the COT index. So the data that we're going to be following here, that is provided by the Commodity Futures Trading Commission, CFTC, and that's just the agency that governs and regulates the futures and options trading in the US market. And what the COT is, it's again historical data. So it's historical records of futures contracts traded under the US market and US exchanges. And it's broken by position type, either long or a short position. And it's listed for 3 distinct groups of traders: the non-commercials, the commercials, and the speculators. What we want to do is we want to understand how all 3 of them act in the market, what they do well and what they may be doing poorly. And I think if we only look at one in the beginning, I think the one that we should be looking at following are the commercials, because the commercials act in the market a lot like us. So the commercials, who are the commercials? They're the users and producers of the commodities, right? They're users and producers. And in short, if I could explain who the commercials are, then I would say exactly this: commercials are institutional powerhouses, superpowers. And so, right, supply and demand, what does it tell us? Supply and demand tells us we want to look for unfilled orders because we want to buy with the big institutions. Well, wouldn't it be great if we can pinpoint who those institutions are and how they operate in the market? If we could historically show that, that is the idea, right? And so these guys, what they're doing, they're not speculating. They're operating a lot like you and I, but they're not speculators. They're using the futures market, and that's really important. They're not speculators. They're using the futures market to facilitate their business activities and needs. Okay, so they rely on selling high and they rely on buying low. They do that to, at the end of the day, run a profitable business. And because they rely on that, it makes sense that these guys that move millions of dollars of real product, whether you're speaking gold miners, whether you're speaking coffee farmers, whether you're speaking Starbucks, whether you're speaking Lindt as a chocolate producer, a chocolate, well, would be chocolate user, right? Even though they're producing chocolate, there would be a cacao and a sugar user. They have to have the best research analysts on staff because they're moving millions of dollars of real product. They depend on buying low and selling high more than anyone else in the game. And so they're the biggest and smartest participant in the game. Now, our advantage as speculators for finite markets, so commodities or man-made commodities like treasuries or equity indices, or even man-made commodities like currencies like Japanese yen, is that we can learn to understand what their actions in the markets mean. What does it mean when they act and how they act in the market? And we want to align ourselves with them. And that is exactly what the COT index is going to be all about. It's supposed to put their buying and selling into context of whether that is bullish at the moment or that is bearish at the moment. And so we want to make sure we trade side by side with these true trading powerhouses. So as you, for example, look at the net position index, you will see that as the price, let's put it like this. What you will find is that as price is rallying, what these guys are doing, they are selling, right? And as price is dropping, what these guys are doing, they are accumulating. They're not actually selling and they're not actually buying. The real terms here is distributing product and accumulating real product, because that's what they do. When they distribute, though, sometimes they distribute product that they haven't even produced yet. And when they accumulate product that they don't even need yet. They need it in the future, right? Futures. They need it with an expiry in the future. So they accumulate things that they need in the future and they distribute things that they haven't even produced yet. And if you just look at this, it seems like they're always wrong. When price is rallying, they're selling. When price is dropping, they're buying. And this is where most people go wrong. I took so long to figure this out as well. It's not their activity at the moment that matters on that day. What matters is their relative net positioning compared to historic highs and lows, which the Campos index tries to make sense of. So if we are at an all-time high accumulation in 20 years, then that is valuable because they have accumulated more than in 20 years. And they're the ones that are relying on buying low for whatever reason, right? Palladium, we could now go into a fundamental analysis and say palladium is needed for batteries. This is why palladium is going to rally. And so we have a lot of people in automotive here. All automotive companies are switching to electric vehicles. There's going to be a lot more batteries that will be needed. Example, Tesla, right? And so, yes, we can do the fundamental analysis. But the thing is, that fundamental analysis only makes sense after a move has happened most of the time. And our fundamental analysis can be wrong. Now, a better way on analyzing something fundamentally is letting the professionals do the fundamental analysis and positioning ourselves when they are positioned at an extreme. So it's the relative extremes that matter. It's not what they do in between. It's the relative extremes that matter. When else were they high? They were high here, rally. They were high certainly here within this range, rally. They were certainly high here, rally, right? And so as you will backtest this, what you will find is they will not be right all the time. But they're the most consistent player in the game that we can follow. And we really want to work on our consistency, right? And so therefore, as we follow them, we have someone really consistent that we can follow time after time after time. Siwar is asking, are there markets where the speculators are stronger than the commercials? They're not markets that I know of where the speculators are stronger, but just like the commercials are not always right, they're the most consistent player in the game. There are some markets where the retailers are also sometimes seemingly right? They're also right. And so the speculators also, they're not wrong all the time, but they're the most consistent loser. Commercials are the most consistent winner. And so the most powerful for us to follow is the commercials, because the retailers can get it sometimes right as well. And the retailers for some markets like commodities, where the market is very small, the contract sizes are very small because it's highly leveraged. Some of those retailers are actually users and producers, but they're just labeled as retailers because their position size is not high enough to put them into a textbook reportable professional trader, a user and producer, right? And so they may be a coffee farmer, but they only have so little coffee. They're so small that they're anyways only trading with a few contracts. And then they're like you and I, even though they may be taking the right decisions because it's their business to be in this market. As well as who trades coffee apart from us, right? Probably no one. They all trade cryptocurrencies. So the retailers that trade coffee
we can also assume that those few probably also have somewhat of an understanding of why they trade coffee. So on some markets, and as you backtest this, you will find that, but later we cover this in detail, that the speculators can get it right. They're not always wrong, but for most part, on average, they're the most consistent loser. Same as the commercials, they do not get it right all the time. The future is fragile. It's really difficult to predict. Even if you have the best analysts on staff, even if you're the biggest player in the game, you will not always get it right. There's no 100%, but they're the most consistent, right? And we want to follow the most consistent. We want to avoid the least consistent. That's the idea. And what commercials are, put in our words as traders, commercials are trend changers or they are trend enders. So when they are accumulating at multi-year highs, very simple, right? If commercials are accumulating at multi-year highs, expect a longer-term bull market. And when commercials are distributing at multi-year lows, expect a longer-term bear market. That is as simple as it is. And so if I look at the commercials here, multi-years are looking back, multi-years, this is 3 years, this is 6 years, this is 10 years, this is 20 years. So if they're at multi-year highs, even this would have been nice, expect a longer term bull market. If they're at multi-year lows, like here they would have been, right? So the net positioning, their total contracts, long versus short, they're extremely bearish here. Multi-year lows, lower than they've ever been at this stage. Expect a bear market to follow, right? And so it works both ways. Very simple as we put it into words. The thing with that is though, that as the trend change occurs in the price chart, we'll see the price chart switching over. We will see that our index will oftentimes abandon the extreme reading rather quickly, right? It will completely flip-flop right away sometimes. That's not because the commercials have changed their mind, right? It's because usually they will begin to hedge off their large positions. And so it's just a hedging function that then comes into play. And that's why oftentimes you will see that immediate flip-flop, though that trend change will play out over time. And so, for example, on the long term, on our long-term index now, you would be saying the commercials are bearish. I wanna sell. And the retailers are bullish. I wanna sell. Well, that is because if I compare the net positioning of today versus the net positioning of 3 years ago, and that is my low, then I am in fact at the point where they were 3 years ago, which then our index would say that's low. Though in reality, that's not low. It's still relatively high, higher than probably a little bit higher than where they were here. And so we need to understand the mechanics of this indicator. And so you can only understand the mechanics by looking at the net positioning as well, and then how this all relates: net positions, indicator, price chart, right? And for a very good example of this, for example, is gold. So on gold, for example, one of the rules that you've learned in the course material, and that is also how I've structured the course material of the Campus COT index, is first I showed you the net positioning report and I explained you the net positioning report, right? And then I went into, hey, how can we just use the COT index to get an understanding of that? So for example, as we're in 2018-19, when we called a bull market in gold back in the day. We called a bull market in gold because the commercials were net long, and they're only net long when things are about to go down, right? Prior to massive bull markets, very rare occurrence. So of course, after they have this crazy positioning, after price will go higher, some of the hedging will come into play. So the Campos COT index will tell you, okay, it's time to be more bearish, it flip-flops, but that's just the hedging function coming into play. It still means that's what they do. They will then sell into rallying prices because that's how they make profit. And so René is saying the COT net commercial index trumps the Campos COT index. No, it doesn't trump. Not one trumps the other. They have their benefits, and both indicators have their benefits and their advantages. One is very easy and objective to read. The other is very difficult to read and to make sense of, especially with smaller time frame changes. But to get the best of both worlds, you want to understand both, right? You want to, as you look at the Campos COT index, you want to, of course, understand how is that made up to make sense of it, right? Because an indicator can only be as good as the person who's using the indicator. And so in the last few times here, buying, all these buying setups on the indicator here, right? Buy, here a little too early. All those buying setups here, buying here a little too early, buying, set up with the index, which if you don't know how to analyze this data looking at only a few months, you're like, damn, how do I analyze this now? Is this now high or is this now low? So the index or indicator takes the guessing game out of the game, the game. So it's no guessing work. I can follow that, but you can only follow that if you understand how you combine long-term, short-term, price chart, how that interacts, also understand the mechanics of what lies underneath, right? Understand that the commercials, all of this is high. All of this is high because it's a multi-year high at the end of the day, right? Multi-year, 2 years, 3 years, 2019 here somewhere. And so it's a multi-year high here, and it's a multi-year high here, and it's a multi-year high here. So all of that will give us buy signals. So that's what our indicator does. It's doing that objectively with a mathematical calculation. It automizes things, but as always, as I said, automation makes our life easier. It makes us understand certain things, learn certain things. But at the end of the day, we always have to use our rationale and our brains and our eyes, because speculation is not a game for automation. It's a thinking game. Does that make sense, René? Perfect. So I know I'm a little bit over time. I'm just gonna cover the commercials here. They're almost done, and then I will write only a couple more things here, and then the speculators we'll cover next time. So when the trend change occurs, again, in the price chart, the Campos COT index will oftentimes abandon the extremes rather quickly. That is because commercials will begin to hedge off their large positions in the market. Very important, right? So how do we look at all this data now? Simple. First of all, we look at the 3-year cycle periods. We use that to get an idea of, is there potentially the end of the band? So a bullish reading would be if the index is above the 80 percentile, the green line. Bullish would also be if the index shows a 1-year or multi-year high, and the index is above the 4-type percentile range. So very good example here is again gold. I think this is the right? So gold here, that is bullish, right? That is bullish. All of these were bullish because these were multi-year highs, and we are higher than the 40 percentile range, or just about there, right? And so this is like midway. What shouldn't happen is like, oh, we are here, down here, and we're saying, oh, this is a multi-year high, but we're down at the close to the 30 percentile range, or whatever that may be, 30 percentile. Up here we were 46, so it's higher than 40, right? And so, and that is the secondary rule. And bearish, vice versa, if the index is below the 20 percentile range, and if the index shows a 1 year multi-year low, plus the index below the 60 percentile range. Again, the strength of this indicator, it's black and white, it's objective, no guessing. There's no understanding about anything what you need to analyze, manually draw lines or whatever you need to do. It simply, in a fast way, objectively, helps you analyze the long-term picture of what the commercials are doing relatively. There's also the short term, which is the 6-month cycle. And for the 6-month cycle, for the commercials, the same is true. So the bullish is when the index is above the 80 percentile range, bearish if the index is below the 20 percentile range. Our advanced golden rules is when we look at the COT net positions. The only thing that the COT net positions will do a lot better than our 3-year cycle periods is historical levels. Our index goes from 0 to 100%. It cannot go higher or it cannot go lower. That's how it's measuring mathematically the data, calculating it. So when you, for example, see that here on gold, this is at 100, the only way this is at 100 is because it cannot go higher. So, you know, as you look at the COT net positions, this is even higher than the net positions 3 years ago. And it may even be an all-time high like we saw for palladium, or an all-time low like we now saw for coffee. Why is coffee moving like a hot knife goes through butter? Of course, our indicator is showing that, right? But why is it moving like a hot knife goes through butter? Because the commercials took a long time to set up here, but the commercials were at an all-time low. They've never been this low before in terms of their distribution. So the coffee farmers that are producing and selling millions of dollars of real coffee, they're selling this like they've never done before. This is very meaningful for us fundamentally. We don't know why this is fundamentally the case. We could have an argument about that. I'm sure that argument would be very weak if we tried to put that into place, or look at the physical supply and demand and all of that. What we just can do is follow their analysis. And so that is the super bullish COT net positions at historical levels or higher than even 3-year highs. And the super bearish is COT net positions at historical lows or lower than the 3-year lows. And precious metals, when commercials go net long, we can predict the beginning of major bull markets. Gold, platinum, palladium, right? And so silver, they were all, well, with the exception of gold, they were all in at or close to net longs. So you can add a lot more as you go through your own back testing phase. Like wheat is one of those that when the commercials also go net long, usually we can predict a bull market. But I like to stay away usually from the net long and the net short picture, because it's not meaningful most of the time, especially as we look at the commercials for most markets, like gold, for example. how they operate is that they are net bearish most of the time. They're below the black line, which is the 0 line. Their longs versus their shorts, they're below that line all the time, right? And that's just because that's how they operate. They sell into rallies. They've always done that. They've done that all their lives. The only time when we become super bulls is when they go into a net long position. And even better if it's then a historical high as well. Everything in between, we also have to analyze somehow, and we do that. That's more advanced. And that's where the indicators help. The easiest is to look at the super extremes. And when those set up, we better pay attention as traders, right? Palladium, coffee, platinum, silver. We have to pay attention when they are at historical levels. It's meaningful. And what is our expectation with all of this? Lastly, and then we finish this. This is a fundamental setup tool and not a timing tool. The commercials can be in extremes for a long time until price starts to move. And then all of a sudden, it can abandon the extreme rather quickly. That's just how they act, right? And so later on, it will also be actually an interplay with the commercials and the non-commercials as well, that eventually will make the markets move. Those two are the biggest players in the game. We'll talk about this maybe next time. And so the commercials, just like any other person in this world, they're not always right. But like we said, they're the most consistent player in the game. And the commercials work best on our finite markets, such as commodities. But they also should be looked at for other man-made commodities, like the British pound, like our Forex futures, like our equity indices. They are what I call man-made commodities, but they're not finite commodities, right? They are man-made commodities. Oftentimes, the commercials will, and the COT will also be meaningful here, but only with a grain of salt, because we can't really pinpoint the users and producers here for them. And so they are, like we said in the beginning, better and more predictive tools potentially for those markets later on the road, or a combination of tools. Truly, for finite commodities, truly is what I believe, especially in line with seasonality, as we align that with, as we anyways, we always align things, right? We never look at things isolated. But as we align things in terms of priority, when it comes to, you want to write this down as well, when it comes to priority, that's why it's the first thing under the fundamental setups here. The priority of our finite commodities is to look at the commercials and try to study them and understand them and align ourselves with them. That is the priority in terms of fundamentals. And then we try to align that with the technicals and the seasonality as well. All right. So I rambled on a little bit today, but I did cover a few examples, which I really wasn't planning too much on, but with the questions that I got, I felt it was probably necessary to do so. And you can also see now we spent 1 hour and 20 minutes on not so much, right? Not so much. And that is because, and we didn't even go back test this and explain this tool for each and every product. So usually when, what I do with my mentoring students is when we analyze a product, we also analyze this in and out, back test all the things, look how they've done in the past. Trading is a study of the past, right? And then we predict the future with that. And so we want to do that for you want to do that for each and every product that you look at. You want to study those tools too when you look at them. If you don't have a mentor, you just have to do that yourself and then ask questions in the newsfeed. But you really want to do that back test, study the history. And with that, you can predict the the future. And so I cannot spend that time with everyone in the room, right? Because we would be sitting here still in a year's time and I'd be doing nothing else than going through the commercials here. And my voice would probably be dead at the end. So without much further ado, are there any questions so far on the topics that we've covered? I hope I've kind of managed to get across the importance of the first 3 steps of the analysis and why they are the first 3 steps. Because the market timing will be easy. First, we need to look at the right kind of setup, and the market timing is just the market timing, right? We'll get that done as well. It's just and then there's also different options, but with the setup, usually we should all look at the same things. And then the market timing, someone may do a different market timing than another person, but the setup should usually be the same. Very rarely the setup is different. All right. Firas, all clear. Cool. Good stuff, everyone. In that case, thank you all for joining. Thank you all for staying until the end. I'll catch you all tomorrow or in the next few days. Until then, stay safe, happy and safe trading, and I'll see you all next time. Ciao.